What does this mean and how does it translate to build to rent? Well, the developers and funds can accept lower returns, returns that don't even work in today's debt environment for those of us who use leverage. How? Well, the expectation is that total returns do provide enough to make it worthwhile deploying the capital. Cash flow is needed if you do have a pension fund, for example, and residential property can provide inflation protection, cash flow, and safety and low volatility. So I might only get to a 3 or 4% return on the capital in the now, but with a 2.5% capital growth forecast, so that 6.5% might well be enough for me to invest. If I'm using a bit of leverage, then that 2.5% capital growth forecast can obviously be leveraged upwards as well. So bear that in mind. My cash flow is also growing though at 2.5% a year, let's say, if that's an average rent increase. And so the best comparison is actually to an index-linked bond, a bond that is attached to the rate of inflation, not a fixed coupon bond like the 30-year gilts, which we said earlier on, are trading around 5.25%, right? So if the index-linked bonds are returning a real 1% on top of the rate of inflation, it's roughly where they've been trading at for some time now. Things have reset themselves, and my build to rent returns, let's say, even 2.5% net after OPEX costs. I've still got a 1.5% premium over and above the linkers.